right, well, we're going to talk about the economy through the lens of central banks. Already today, people talking about the latest action from the ECB. You've heard comments from the U.S. President Donald Trump urging the American central bank to cut rates. We had an interest rate decision in this country yesterday, but the BoC governor, Tiff Macklem, decided that he would keep rates just where they are for now, as the Bank of Canada continues to watch how things unfold with the trade conflict with the United States. There were a couple of things that the bank pointed to in keeping rates steady for now, such as the performance for Canada's economy in the first quarter, which of course was the action happening in this country before we really got into the heated trade war, and what they are seeing in one of their preferred inflation measures. However, the decision to stay on hold at a time when there are other signs of uncertainty in the market, and we might get more clarity on that with the next jobs report, have left some wondering why the Bank of Canada did not take action yesterday, including our next guest, who joins us from time to time with some great insights on the economy and will be sitting with us here for the next 30 minutes. David Rosenberg is the founder and president of Rosenberg Research, and it's nice to have you back with us.
Thanks, John.
Okay, so let's start with the state of affairs here in Canada. You heard what Tiff Macklem had to say yesterday with the decision to stay on hold. What was your reaction?
Well, I think the situation was this. The bank didn't say anything in the lead up to the meeting to talk the markets out of pricing in nothing. So to go ahead and cut interest rates yesterday would have been a bit of a shock and probably a source of confusion. I do think that the bank should have prepped us for a cut. I do believe that they should have cut. And the economy, I mean, look, the bank told us to look through that first quarter performance. I mean, there were a lot of distortions, pre-tariff, exporting and buying activity. And of course, we were still coming off, the sales tax holiday. So a lot of that was just pure artificial. And the bank says, and look forward for a sharp deceleration in the economy going forward. And that just tipped me off right there, because a central bank should not be looking at backward-looking data. Right? And so you can say, well, the last couple of inflation prints were a little stronger than expected. There's reasons for that. I don't think that it's going to be sustained. But I respect central banks that are forward-looking. I can understand that we're in a bog of uncertainty. But their own forecast is telling you that they should be cutting interest rates. And as low as they are, as low as interest rates are, they're clearly not low enough, especially for the household sector, when you consider the delinquency and default cycle that we're in right now.
And you, even ahead of this decision, were pointing to some other data points, which, I mean, I guess everything from yesterday is backward looking, but you pointed to, some signs in the jobs market that were concerning you when it comes to the economy. We're about to get more evidence of what's happening in the jobs market, so we'll see what happens there. I would imagine, depending on what happens in the employment world, that could impact things like housing and the mortgage market. What are the ramifications, do you think, of just sort of holding firm for now, especially if, as you mentioned, we've got this unknown with what happens with the trade front, and people keep pointing to the fact that you have this important inflation reading for the Bank of Canada, the core inflation reading, which, would suggest that inflation is still a problem.
Inflation is not a problem, okay? We had a couple of above expected prints. Underlying inflation, headline inflation, has come a long way down from where it was at the peak. But here's the problem, is that it's a lagging indicator. The Bank of Canada, and I'd say even more so for the Fed, they are focused on contemporaneous and lagging indicators. And, when I mention this to people, look at the labor market. Okay, look what the unemployment rate is doing. We're up almost 2 percentage points in the past 2 years. We're pressing against 7%. And the comeback is, well, the Bank of Canada has a single mandate, and it's inflation, or core inflation. But you have to look at the labor market, because as we're building up more excess capacity, slack in the labor market, what's going to happen with these price increases? And let's say they're tariff-related. They're going to hit the wall in the labor market. As the labor market slack continues, nominal wage rates go down, the price spike leads to negative real wages then translate into negative real consumer demand, and that ends up bringing inflation down substantially over the next 6 to 12 months. See, if I was expressing a view as opposed to backward-looking indicators that are in the rearview mirror, that's how I would portray it. That's why the bank should be cutting interest rates, besides the fact that you lift up the newspapers and everybody's saying, well, we should hit back the U.S. with countervailing duties because of the steel and aluminum. You know, that's counterproductive. What the Bank of Canada should be doing, if you want to find out the best way to protect the Canadian economy in this bog of uncertainty, is just stimulate the economy. And the Bank of Canada really has one tool, which is interest rates. So they should be they already took out insurance policies on the future of the economy. I don't know why they've stopped. I really don't have a clue. If they're freaked out because of a couple of above expected CPI prints in the context of the labor market deteriorating substantially, that's a real mystery to me.
So it's a lost opportunity to look at a very likely scenario if the trade war continues and the impacts on the economy and the impacts on, you know, people's jobs, to sort of hold pat for now and to not take action in advance.
No matter what survey you're looking at, okay, we'll get a fresh number tomorrow. Employment is contracting, and the unemployment rate is going up. And the rate of change in the unemployment rate, which is more important than the level, is telling you that there's an 80 to 90% chance this economy is slipping into a recession. And so the Bank of Canada, don't forget that there's lags between what the Bank of Canada does in day one and then the impact on the economy. They should be taking out additional insurance, especially given the bog of tariff and trade uncertainty. But there's something else that's not being discussed, okay? And it should be, because we just came off the Chartered Bank, the Canadian Bank earnings numbers. What defined those earnings numbers was a dramatic increase in provisioning for loan loss reserves.
Setting money aside for potentially bad
and
loans.
So what's that telling you about what the banks are seeing about the future of the consumer, okay? So people say to me, John, people say, well, you know, they've cut the overnight rate to 2.75%. Who cares? Do you borrow at the overnight rate? I know I don't borrow at the overnight rate. The average interest rate, the effective interest rate in the household sector today in Canada is 5.7%, okay? What was the average in the past 5 years? Was 3.5%. The average interest rate confronting the household sector is 120 basis points above what the average has been in the past 5 years. And people are resetting, especially in the mortgage market, at these much higher interest rates. So on top of what's happening on the employment side, that's going to be an additional drag on consumer spending power, the run-up in interest payments in terms of what they're siphoning out of disposable income. Right. That comes out of retail sales. That comes out of consumer demand. That is going to be another source of disinflation going forward. Besides the fact we just got the numbers from Toronto real estate prices. Came out yesterday, right? And you're having a boom in new listings. Sales are way down. Prices are down 4 to 4.5% year over year. This is a $4 trillion asset class on household balance sheets, residential real estate, and it's deflating. The biggest asset class on the household balance sheets deflating, and we have a central bank lamenting about a couple of above expected CPI numbers. Are you kidding me? So no, the rates have come down quite a bit, the overnight rate. The effective interest rate in the household sector has not come down as much as the overnight rate has, and so we need more relief on that score.
Well, you know, if we weren't talking about Trump and tariffs, we would have been talking about the wave of mortgage renewals this year. So we're going to take a quick break. Before I do, though, because you talked about percentages of a recessionary environment. I think, you know, increasingly people are trying to figure out, they'll see a headline about a recession, trying to figure out, is there a recession coming? Are we in a recession? Generally, you're talking about a couple of quarters of negative growth of that happening. We had a solid Q1, but as you mentioned, there was activity before the tariff war kicked into gear. So are you anticipating we'll see negative growth sort of second quarter, third quarter? Like what's the determining factor here?
Well, firstly, that's Wall Street, Bay Street colloquialism about back-to-back negative quarters of GDP.
That's true.
Yeah, that doesn't define, it's a rule of thumb.
Yeah.
The final arbiter of the recession call in Canada is actually with the C.D. Howe Institute. And they have different measures of severity of a recession. It could be mild, could be medium, could be severe. But do I think that Canada is heading into a recession? Well, the labor market is already telling you that. We are shedding jobs. I think the consensus for tomorrow's number, not that it's gospel, is still for another negative. And you're seeing widening slack, which means that wage rates are going to be decelerating. What does that mean for consumer spending, especially in the context of what is an unrelenting delinquency cycle right now? You see these delinquency rates across, whether it's credit cards, auto loans, mortgages. And the Bank Canada, the staff at the Bank Canada itself calls it a mortgage renewal wall happening starting this year into the end of next year. So yeah, I think that the conditions for a recession are here, and I think the Bank Canada should, you want to get ahead of that. And the trade and tariff situation just adds a level of complexity. I don't see that as being inflationary in Canada. It could be inflationary in the United States because their importers pay the duty. Okay, this is actually, in my opinion, a deflationary shock on the Canadian economy. Unless we go through countervailing retaliatory tariffs in the United States, what's the inflation story in Canada? I come back at a time when the labor market is slackening. If whatever inflation you think we're going to get is going to hit the wall in the labor market, it will not be sustained. This is not the same sort of shock that we had in 2021, 2022, when demand for labor was surging and there was a massive mismatch between demand and supply for labor. And you had about an 18-month wage price spiral, both in Canada and the United States. That's why it wasn't transitory. Okay, the labor market, especially in Canada, is in a different orbit today than it was a few years ago.
All right, a lot to chew on there. We'll see what the jobs numbers look like and what the Bank of Canada thinks about with its next rate decision.